stop what you're doing right now because something just shifted in the crude oil market that most people are completely misreading. Oil to $120, that's the number suddenly being whispered across energy markets. Not because of economic growth, not because of booming demand, but because of something far more unpredictable: war risk in the Middle East. Over the past few weeks, tensions across the region have escalated dramatically. Energy traders, governments, and investors are all asking the same question: what happens if the conflict spreads further? Because the Middle East is not just another region in the global economy. It sits at the center of the world's oil supply, and when instability appears there, the ripple effects can spread through the entire global economy. Oil prices have already surged sharply as the market begins pricing in the possibility of supply disruptions. Some estimates show crude climbing close to $120 per barrel during recent spikes as geopolitical tensions intensified. So in this video, we are going to break down why oil prices react so strongly to Middle East conflicts, the strategic choke points that could disrupt global supply, how 120 oil could impact inflation and financial markets, and what investors should watch next, because when energy markets move, the entire global economy feels it. Welcome back to John Forecast, where we decode the macro forces behind the gold, silver, and global market moves. Why the Middle East matters so much for oil. To understand why the market reacts so quickly to tensions in this region, you have to look at the geography of global energy supply. A huge portion of the world's oil comes from the Persian Gulf. Countries like Saudi Arabia, Iran, Iraq, Kuwait, United Arab Emirates, together, they produce a massive share of global crude oil. But the real vulnerability isn't just production, it's transportation. Most of that oil has to travel through one extremely narrow shipping route before reaching global markets: the Strait of Hormuz. This narrow waterway connects the Persian Gulf to the Gulf of Oman and the open ocean. And it's one of the most strategically important energy choke points in the world. Roughly 20% of global oil supply moves through this passage every single day. That means if this route becomes disrupted, even temporarily, the consequences for global energy markets could be enormous. Tankers could be delayed, insurance costs for shipping could spike, and global oil supply could suddenly tighten. But here's where things get even more concerning. The market isn't just worried about shipping lanes, it's worried about actual supply losses. The risk of supply disruption. In recent weeks, several energy analysts have warned that escalating tensions could remove millions of barrels of oil from the market. In fact, some estimates suggest that disruptions across the region could reduce global oil supply by up to 7 million barrels per day, roughly 7% of total global production. To put that into perspective, the entire global oil market currently consumes roughly 100 million barrels of oil per day. So a sudden loss of even a few million barrels can create a massive supply shock. When supply drops quickly and demand remains strong, prices tend to rise rapidly. This is exactly what energy markets fear when geopolitical conflicts intensify. The price spike. Already happening oil prices have already reacted. In some cases, crude prices have surged nearly 30% during recent geopolitical escalations, with Brent and WTI crude climbing toward the $120 level. Markets are essentially pricing in a risk premium. That means traders are adding extra cost to oil prices because they fear potential disruptions. Even if the worst case scenario never happens, the possibility alone can drive prices higher. And historically, this is not unusual. Oil markets are extremely sensitive to geopolitical shocks. But to understand just how big this risk could be, we need to look back at history, because the world has seen this movie before. The history of oil shocks, several times in modern history, geopolitical conflicts in the Middle East, have triggered major oil price spikes. One of the most famous examples occurred during the 1973 oil crisis. During that crisis, oil-producing nations restricted exports, causing prices to surge dramatically. The shock sent inflation soaring across the United States and Europe. Gasoline shortages appeared, and the global economy slowed sharply. Another major example came during the 1979 Iranian Revolution oil shock. Political turmoil in Iran disrupted oil production, setting prices sharply higher once again. These events changed how governments and financial markets think about energy security. Even today, policymakers closely monitor Middle East stability because they know how quickly disruptions can ripple through the global economy. Why oil markets react. Before the crisis, one of the fascinating aspects of energy markets is that prices often rise before actual disruptions occur. That's because markets are forward-looking. Traders try to anticipate future risks. If investors believe there is even a small probability that oil supply could be disrupted, they begin adjusting prices immediately. This behavior creates what analysts call a risk premium. The price of oil rises not just because of current supply and demand, but because of the fear of future shortages. The economic domino effect. When oil prices rise sharply, the effects spread quickly across the economy. Oil is one of the most important inputs for modern industry. It powers transportation. It fuels airplanes and cargo ships. It supports manufacturing and agriculture. So when oil becomes more expensive, costs increase across multiple sectors. Gasoline prices rise, shipping costs increase, food production becomes more expensive, and inflation pressures begin building across the economy. In fact, economists often describe oil as the lifeblood of the global economy, which means when oil prices spike, the entire economic system feels the impact. But here's the key question investors are now asking. Could this escalation push oil all the way to $120 per barrel, or even higher? The $120 oil scenario. So now we arrive at the question dominating energy markets. Could oil really reach $120 per barrel? To answer that, we need to understand how sensitive the oil market actually is to supply disruptions. Global oil demand currently sits around 100 million barrels per day. But the system that supplies that oil operates with very little spare capacity. Most oil-producing countries already pump near their maximum levels. That means if supply suddenly drops, even by a few million barrels per day, the market can tighten extremely fast. This is why analysts say the oil market is structurally fragile. A relatively small disruption can trigger a very large price move. And that's exactly why geopolitical tensions in the Middle East are taken so seriously by energy traders. But the story isn't just about conflict, it's also about who controls spare oil production capacity. And that brings us to one of the most powerful forces in global energy markets, the role of OPEC in oil prices. The global oil market is heavily influenced by the actions of the Organization of the Petroleum Exporting Countries, commonly known as OPEC. This group includes some of the world's largest oil producers, including Saudi Arabia, Iraq, Kuwait, United Arab Emirates, Iran. Together with partners such as Russia in the OPEC Plus alliance, these countries control a huge share of global oil supply. Their production decisions can significantly influence prices. When OPEC Plus reduces output, supply tightens and prices often rise. When production increases, prices can fall. In recent years, OPEC Plus has repeatedly cut production to support oil prices and stabilize markets. But during geopolitical crises, their ability to increase production quickly becomes extremely important. Because if major supply disruptions occur, only a few countries have the spare capacity needed to replace lost oil. And the most important of those countries is Saudi Arabia. Saudi Arabia, the swing producer. Saudi Arabia plays a unique role in the global oil market. The country has historically maintained spare production capacity, meaning it can increase oil output relatively quickly when necessary. This makes Saudi Arabia what analysts often call the swing producer. When markets become tight, Saudi Arabia can raise production to stabilize prices. But even Saudi Arabia's spare capacity has limits. If disruptions in the Middle East remove several million barrels per day from the market, replacing that supply would be extremely difficult. And that's when oil prices could surge dramatically. But here's something many people don't realize. An oil shock doesn't just affect the energy sector. It can reshape the entire global economy. The inflation domino effect oil is deeply embedded in nearly every part of modern economic activity. When oil prices rise sharply, the impact spreads across the economy like dominoes. Transportation costs increase, shipping costs rise, airline fuel expenses surge, manufacturing becomes more expensive. Agriculture costs increase because fertilizers and machinery rely heavily on energy. All of these rising costs eventually show up in consumer prices. Gasoline becomes more expensive, utility bills rise, and inflation begins accelerating across the economy. This is one of the main reasons policymakers closely watch energy prices, because oil shocks have historically triggered inflation spikes. And inflation can force central banks to make difficult decisions. The impact on U.S. gasoline prices. For American consumers, the most visible impact of rising oil prices is gasoline. Crude oil accounts for a large portion of gasoline production costs. When oil prices rise, gasoline prices usually follow. Historically, every $10 increase in oil prices can raise gasoline prices by roughly 25 to 30 cents per gallon. So if oil climbs from $80 to $120 per barrel, that could potentially add $1 or more per gallon at the pump. For households across the United States, that increase can significantly affect monthly budgets. Higher gasoline prices also reduce disposable income, which can slow consumer spending. Since consumer spending represents a major portion of the U.S. economy, rising fuel costs can ripple through economic growth. But rising oil prices don't hurt every part of the economy. Some sectors actually benefit. Energy stocks. During oil booms, when oil prices surge, energy companies often experience major gains. Oil producers earn more revenue for every barrel they sell. This can boost profits for large energy companies such as ExxonMobil, Chevron Corporation, ConocoPhillips. During past oil price rallies, energy stocks have sometimes significantly outperformed the broader stock market. For investors, this dynamic creates an interesting situation. Higher oil prices may increase inflation and economic pressure, but they can also create opportunities within the energy sector. The U.S. energy advantage. Another important factor influencing oil markets today is the rise of American energy production. Over the past decade, the United States has become one of the largest oil producers in the world. This transformation was driven largely by technological advances in hydraulic fracturing and horizontal drilling. The U.S. shale industry dramatically increased production, especially in regions like the Permian Basin in Texas and New Mexico. As a result, the United States now produces more oil than any other country. This shift has improved U.S. energy security and reduced dependence on foreign imports. However, even with strong domestic production, the United States is still affected by global oil prices. Because oil is traded on a global market, supply disruptions anywhere in the world can influence prices everywhere. But here's where the story gets even more interesting. Because geopolitical crises often trigger secondary market reactions beyond just oil. And those reactions can move commodities, currencies, and financial markets. The broader commodity ripple effect. When energy prices rise sharply, other commodities often follow. Natural gas can rise. Industrial metals may increase due to higher production costs. Agricultural commodities can climb because energy is a key input for fertilizers and farming equipment. Even precious metals like gold sometimes rise during geopolitical crises as investors seek safe haven assets. This interconnected nature of commodity markets means that a major oil shock can trigger a broader commodity rally. And when multiple commodities rise at the same time, inflation pressures can accelerate quickly. When analysts talk about the biggest geopolitical risk to global oil supply, one location almost always comes up first: the Strait of Hormuz. This narrow waterway sits between Iran and Oman and connects the Persian Gulf to the Arabian Sea. At its narrowest point, the shipping lanes are only a few miles wide. Yet despite its small size, this passage is one of the most critical energy routes on the planet. Every day, enormous oil tankers pass through this corridor, carrying crude oil from the Persian Gulf to global markets. According to energy analysts, roughly 1/5 of the world's oil supply flows through this single choke point. That means nearly 20 million barrels of oil per day pass through the Strait of Hormuz. To put that into perspective, that's more oil than the total daily production of the United States. This is why markets react so quickly when tensions rise in the region. If shipping through this route were disrupted, even temporarily, global oil supply could tighten almost instantly. But here's something that makes this situation even more fragile. There are very few alternative routes for this oil to reach global markets. The limited alternatives. Some pipelines exist that allow oil to bypass the Strait of Hormuz. For example, Saudi Arabia operates pipelines that move crude from the Persian Gulf to ports on the Red Sea. The United Arab Emirates also has infrastructure allowing some oil exports to avoid the strait. However, these alternatives can only transport a portion of the region's total oil output. If tanker traffic through the Strait of Hormuz were significantly disrupted, millions of barrels per day could temporarily disappear from global markets. And in the oil market, even small disruptions can trigger huge price swings because global supply and demand are already tightly balanced. The worst case scenario. So what would happen if tensions escalated dramatically and shipping through the Strait of Hormuz was interrupted? Energy analysts often model this type of event as a major supply shock. In some scenarios, global oil supply could drop by 5 to 10 million barrels per day. To understand how big that is, remember that global oil consumption is around 100 million barrels per day. So losing even 5% to 10% of global supply could send prices soaring. In extreme cases, analysts say oil prices could spike well above $120 per barrel. Some forecasts even suggest that a severe disruption could push oil toward $150 or higher temporarily. Markets would react immediately. Energy traders would scramble to secure supply. Shipping insurance costs would surge. And governments around the world would likely begin tapping emergency reserves. But interestingly, the oil market has already started pricing in some of this risk. The geopolitical risk premium energy traders often talk about something called the geopolitical risk premium. This refers to the additional cost added to oil prices when markets believe supply disruptions are possible. Even if the disruption hasn't happened yet, the possibility alone can push prices higher. Think of it like an insurance policy. Buyers are willing to pay more today to secure oil supply tomorrow. This is why oil prices sometimes surge even when physical supply hasn't changed. Markets are simply preparing for potential risks. And during periods of geopolitical tension, that risk premium can grow quickly. The Strategic Petroleum Reserve. When oil markets become unstable, governments often rely on emergency stockpiles. In the United States, the most important of these reserves is the Strategic Petroleum Reserve. The Strategic Petroleum Reserve, often called the SPR, was created after the 1973 oil crisis to protect the U.S. economy from supply disruptions. The reserve stores hundreds of millions of barrels of crude oil in underground caverns along the Gulf Coast. If a major oil shock occurs, the U.S. government can release oil from the SPR to stabilize markets. This strategy has been used several times in recent years when energy prices surged. However, emergency reserves are not a long-term solution. They are designed to provide temporary relief during crises. If supply disruptions persist for months, markets would eventually need new production to restore balance. And this brings us to another important question. If oil prices spike to $120 or even $150, who actually benefits? The winners of an oil shock. While high oil prices create challenges for consumers and businesses, some sectors actually benefit significantly. Energy producers typically experience higher revenues and profits during oil price surges. Major companies such as ExxonMobil, Chevron Corporation, ConocoPhillips often see their earnings increase when oil prices rise. Oil-producing countries also benefit from higher prices. Nations that export large volumes of crude can generate massive revenues during oil booms. This dynamic can reshape global economic power. Countries rich in energy resources often gain influence when oil markets tighten. Meanwhile, energy importing countries face rising costs and inflation pressures. The impact on global markets. Historically, major oil shocks have had powerful effects on financial markets. Stock markets often become volatile when energy prices surge. Inflation can accelerate. Central banks may face difficult policy choices. Higher energy costs can slow economic growth while simultaneously pushing prices higher, a situation economists sometimes call stagflation. During the oil shocks of the 1970s, the U.S. economy experienced both high inflation and slow economic growth at the same time. This combination created one of the most challenging economic environments in modern history. That's why policymakers today closely monitor energy markets, because oil shocks can spread quickly through the global economy. But despite these risks, there's another side to this story, and it involves how markets adapt over time. One of the fascinating things about global energy markets is their ability to adapt over time. Even after major supply shocks, markets eventually find ways to restore balance. When oil prices rise dramatically, several things tend to happen simultaneously. First, energy companies increase production. Higher prices make drilling more profitable, which encourages producers to bring new supply to the market. Second, consumers begin adjusting their behavior. So when gasoline becomes expensive, people drive less, use public transportation more frequently, or switch to more fuel-efficient vehicles. Third, governments often implement policy changes designed to stabilize markets. Strategic reserves may be released, energy subsidies may be introduced, or diplomatic efforts may focus on stabilizing supply from key regions. Over time, these adjustments help bring supply and demand back into balance. But the key word here is time, because in the short term, oil markets can remain extremely volatile. The shale factor. One of the biggest changes in the global oil market over the past decade has been the rise of U.S. shale production. Thanks to technological advances in hydraulic fracturing and horizontal drilling, the United States has become the world's largest oil producer. Regions like the Permian Basin in Texas and New Mexico have dramatically increased output. This surge in production has fundamentally changed global energy dynamics. In the past, the United States relied heavily on oil imports from the Middle East. Today, domestic production supplies a large portion of U.S. demand. This has improved America's energy security and reduced vulnerability to external shocks. However, even with strong domestic production, the United States is still influenced by global oil prices. Because oil is traded on international markets, supply disruptions anywhere in the world can push prices higher everywhere. That means American consumers still feel the effects of geopolitical tensions in distant regions. But here's something investors are paying very close attention to right now. The next oil shock might not look exactly like the ones we saw in the past. The new energy landscape. The global energy system is evolving. Renewable energy is expanding. Electric vehicles are becoming more common, and governments are investing heavily in alternative energy technologies. However, despite these changes, oil remains one of the most important energy sources in the world. Transportation, aviation, shipping, and many industrial processes still rely heavily on petroleum. Global oil demand continues to hover around 100 million barrels per day. That means even as the world gradually transitions toward cleaner energy sources, oil will likely remain essential for many years. This reality creates an interesting dynamic. Energy markets are simultaneously preparing for a long-term transition while still responding to short-term geopolitical risks. And when geopolitical tensions escalate, those short-term risks often dominate market behavior. The investor perspective. For investors, rising oil prices can create both risks and opportunities. Higher energy costs can increase inflation and slow economic growth. This can put pressure on stock markets and consumer spending. However, energy companies often benefit when oil prices rise. Higher crude prices typically translate into stronger revenues for oil producers. Large companies such as ExxonMobil, Chevron Corporation, ConocoPhillips have historically performed well during periods of elevated oil prices. Investors also sometimes look at energy exchange traded funds or commodity funds that track oil prices. But it's important to remember that energy markets can be extremely volatile. Prices can surge quickly during crises, but they can also fall rapidly once tensions ease. This volatility makes timing difficult for many investors. And that leads us to the final question. Is $120 world oil actually realistic? Could oil really reach $120 based on historical patterns and current market conditions? The answer is simple. Yes, it's possible. Oil prices have reached similar levels before. During previous supply shocks, prices surged dramatically in relatively short periods of time. If tensions in the Middle East escalate further and supply disruptions occur, prices could climb quickly. Markets might react even before any physical supply loss occurs, simply due to rising geopolitical risk. However, reaching $120 oil would likely require a significant catalyst. That catalyst could be major supply disruptions, shipping disruptions in key energy choke points, unexpected production outages, or a rapid escalation of geopolitical conflict. Without those triggers, prices may fluctuate but remain within a lower range. What U.S. consumers should watch. For Americans, the most immediate impact of rising oil prices appears at the gas pump. Gasoline prices respond quickly to changes in crude oil. Higher fuel costs affect household budgets, transportation expenses, and overall inflation. This is why energy prices often become a major political and economic issue in the United States. Policymakers closely monitor oil markets because sharp price increases can influence public sentiment and economic performance. If oil prices surge dramatically, governments may take action through strategic reserves, policy adjustments, or diplomatic efforts to stabilize supply. The big picture. So when we step back and look at the global energy landscape, several key trends emerge. Geopolitical tensions remain a major driver of oil market volatility. The Middle East continues to play a critical role in global energy supply. Shipping choke points like the Strait of Hormuz remain strategically important. And even in a world gradually transitioning toward renewable energy, oil still sits at the center of the global economy. All of these factors mean that energy markets will likely remain highly sensitive to geopolitical developments. And when tensions escalate, oil prices can move quickly. Final thought. So here's the big question. If geopolitical tensions continue rising, could oil really surge to $120 or even higher? Or will markets stabilize as production increases and diplomatic efforts ease the risk? Let me know what you think in the comments. And if you want more deep dives into oil markets, gold, commodities, and global geopolitics, make sure to subscribe. Because the forces shaping energy markets today could define the next major economic cycle. Thanks for watching, and I'll see you in the next video.